All right. Hello, everybody. Just want to make sure, Vicky, are we good in YouTube?
Am
Am I coming up in there?
Not yet, but
Oh. I think,
it could be me.
okay. I think I see.
Yep.
Yeah. All right, cool. Great. All right. Hello, everybody. Welcome back. I was on vacation last week. Hope everybody had a great call. Before we get into married puts and protective puts today, I wanted to start on this slide. This actually, Suzanne must have, when she taught this originally, she must have just been releasing the Doji's Rumble because this was at the front of her slide deck there. And I wanted to leave it in because we're getting close to the holiday season. I really like to read that book to my son. I just think it's a great way to introduce candlesticks to kids. And I think about my trading journey. And when I first started, everything was new to me. I didn't know what a stock was. I didn't know. So of course, I didn't know what a candlestick chart was. And everything was completely overwhelming to me at first. And I think about how that will be different for my son. Yes, because he watches me. Sometimes he watches me chart, or sometimes he's around when the market is open. But I think more important than that, we have this book. And so he's introduced to candlesticks through this book. And it's something that he really enjoys. So I would just take a moment and say that for anybody who has young children in their family, young children of their own, I just think it's a great way to introduce these ideas to them. The stock market is never going to be as foreign and intimidating to my son as it was when I first started. And this is a big reason why. All right, moving right along. We've got to always trade responsibly. Past performance, whether actual or indicated by historical tests of strategies, is no guarantee of future performance or success. There is a possibility that you may sustain a loss equal to or greater than your entire investment, regardless of which asset class you trade. Therefore, you should not invest or risk money that you cannot afford to lose. Options trading is not suitable for all investors. Today, so funny. It's so funny that we had this huge, like ridiculous bullish day today, because when I was getting ready to put this presentation on last night, I was like, man, a married put and a protective put is assuming a long position. And I just didn't want to use the SPY chart for that. So, for obvious reasons, but, of course, we get a huge bull day today. But what I chose to do was pick a sector that's been largely bullish during our bearish run on the S&P 500. So the S&P 500 is divided into 11 sectors, as a lot of us know. XLE does not make up a large weight of it, but it's our energy sector. It's had a bullish year. And so I just felt that to present this trade idea, it would make more sense to use a bullish sector example than it would to use SPY itself. But what we're going to try to do is dissect a trade idea gone wrong and two defensive strategies that could be used along with it. All right, so the first one we're going to break down is a married put. A married put just means that while you're going long, and you're buying a in the money or close to at the money call, you are also buying a cheaper put along with it. And the idea being that you're putting that position on, you're increasing your cost to enter, but in increasing that, you're buying yourself a little bit of insurance in case the trade doesn't go the way that you thought that it would. And so a protective put doesn't necessarily have to be entered at the same time that you enter your long put. And so that's the difference. We're going to break down scenarios for how we would use both of them, but we're going to start focused on the married put. And so just to draw your attention to the center of this screen, I'm going to pretend that we were a trader considering going long right here when we see this double top broken. So we see we've got this high, then another high, some consolidation, and a break. And because we're thinking of energy as being so bullish at the time, we have eyes to maybe try to hit this high. Notice that if we take out this double top, it's pretty smooth price action going down, which in our mind at the time, we're thinking, hey, maybe we'll get some smoothish price action going up. So we pay for time, get into an option to express that trade. But at the same time, we also put on a married put and we say, you know what? If this recent low is taken out, I want to have some protection. And so I'm going to show you in the option chain what that would look like. And so once again, this double top right here at $78 roughly, if you were to enter that, and again, I always use on demand for these examples just to give a really clean example of how options were trading at the time. The $78 call is trading for $6, or 78 strike, I should say. Call is trading at $6. And what we could do is look at before we look at protection. I also just wanted to point out, if we go back to this high, you're looking at roughly $14 of growth. And so that would be your target. And so I just wanted to give a brief review that an easy way to try to think like, hey, if price just were to rocket up there and I didn't have to worry about theta, then I would be looking at, $14 deep in the money, and I'd be looking at about $10 of profit. So 1,000 actual, US dollars of profit on that position. So that would be your trade idea as you're getting into it. But we also want to think about where to place that married put. And so what the idea behind the married put would be, I think price is going to run up. I'm not so sure. I don't necessarily want to babysit this trade. Watching it all the time, like Jay does, like I watch my trades like a psychopath, but more laid back strategy would say, hey, I'm going to get in long with this call, and I'm also going to buy a married put in case price really goes against me. And so what that would look like is, you know what, I apologize. I assumed, I just wanted to draw everybody's attention to the expiration and just say that, hey, this would be a trade idea where you think that you're going to be long over the course of some months. So that's why you see that to go long on the call is a 92 days to expiration, but you don't necessarily need to buy protection right when you get in for that entire time. So since you're thinking about being in such a long position, you could perhaps give yourself a bit of a discount and say, you know what, I'm gonna try to get about 2/3 of that time. So the married put comes in at closer to 60 days until expiration. And so notice that at that strike price that we were thinking of, like, hey, if price really goes against me, I want to have some protection. Well, now you're adding $1.78 to your cost. So originally you looked at a $6 long call. Now you're looking at $7.78, close to $8 to enter, but you do have some peace of mind in terms of protection. And it means that it's going to cut down on your profits. So if you were looking at that max gain of close to $1,000, well, now you're paying close to $200 for protection. So your max gain is going to be dropped down to about $800, but it does give you downside protection on the position. And so this is what that order would look like. Note that we have two different expirations. So you would shop in two different options chains to get that. And note that you're long at 78, but you have a put significantly for the puts out of the money, and that's what makes that position a cheaper. And so it's cost effective to give you that insurance. And so now let's go back to the chart. Remember, in our imagination, we entered here when the double top was broken. And initially, price moved the way that we wanted it to. Who knows? Some traders probably would enter with a larger position size and perhaps scale out in this area, but we're just going to keep it nice and simple and pretend we're just entering with one call and one put. And so then we get in here. Obviously, I just want to point out this happens so slowly that in my mind, it probably gives the trader an option to get out or adjust, aside from just like letting it fall off the face of the earth against you. But I just want to point out that the married put makes this loss relatively negligible. So even if you really were not watching and price, you can see price obliterates this position, you still get out with a reasonable loss as opposed to getting hammered. And so this is what that loss would look like. Notice that if you just had the long call on, you'd be looking at $432 loss. But because you have the put protection, $185, then now your P&L is only at $250. So is it ideal? No, but it's better than not having that protection on. And so that's the idea behind entering a long position and then immediately buying some insurance in the form of a married put. I also want to stress that the reason why we're going over this is actually to get into the protective scenario, because I think that the protective scenario is a much easier one to extrapolate to live trades. The last time that we had a conversation, we were talking about we were talking about an iron condor I was in that I had to defend. And how was I defending that iron condor? This is basically going to give us the building blocks and tools that we need to defend positions, or just thinking about how to defend positions. And so this would be the same trade, but thinking in terms of a protective put. So again, married put, you enter both options long at the same time. Protective put, you just think like, hey, there may be a time where I need to protect this position because it's not getting where I need it to go as fast as I wanted to get there. So this is what that would look like. Once again, we are just long at 78 for $6. And so I drew our attention to this area of price action, where maybe a trader would start to have suspicions that they need to pay for protection. And so the reason, and I'm just going to sort of give some thought processes behind, maybe if I were in a position here, I would be concerned that we're going to go lower before we have an opportunity to go higher. So notice we take out this double top, yes, but we also clearly post a reversal here. And when we do, we create these little double bottoms, which are taken, and then price really dies before it takes this next high. So if you think about your entrance here, you put in a little low here, which gets taken, and then almost we're starting to see this consolidation without a real willingness. The market's not really demonstrating for us a willingness that it wants to come up here. It feels like it wants to get heavy and go lower here. And so this is where a trader might be thinking, maybe it's time for me to pay for some insurance. Just in the case that even though I'm still bullish on this position overall, my entrance might not be working out for me. And so my idea was originally to say, well, hey, what if I just bought this 70 strike again? Because remember, what we're trying to protect ourselves against is is this low right here at $70. But if you notice that delta, is extremely small. Sorry everybody, my laptop's telling me my internet connection is unstable. I just want to check it to make sure that you all can hear me. I think I should be good.
We can hear you now, but you did glitch out for a second.
Did I? Did you hear what I was trying to say about how I'm choosing this strike over this strike?
Yes.
Okay, great. And so essentially, if we spend $1.77, which was, if we go back in your memory to the married put, if we would have gotten into that position, would have been $1.78. Here is just a little bit more of an artful place to spend that same cost. So give yourself a stronger delta protection. That's also going to really ramp up when this gets, if price goes against you and this gets in the money, it's going to accelerate your protection a lot faster than this would. And I just think that given what the chart is telling you, it makes sense. And given the idea that you said, you know what, at some point I might pay for protection anyway, go ahead and actually pay for some strong protection at the 75 strike, because it's going to give you more bang for your buck. And so if we look at what happened after this, notice we do take out these lows, consolidate for a few days, and then, really large gap. Having that protective put on your position is going to make thinking about this a lot easier for a trader, because all of a sudden you're not necessarily managing a horrific loss or a loss that's larger than what you wanted to take. You're managing a position and just trying to think, hey, it's sort of your heart rate is going to be lower, and you're going to be able to focus and process, hey, what's actually my best play here, not necessarily what's my most emotional play here. And so what that would look like is actually, as you can see, a $25 gain on the position. Obviously, when we entered the position, we're hoping to make in between $800 and $1,000. So this is not the goal when you enter the position, but entering a protective put at a proper time, when you start to anticipate that things might be going against you, can at least go a long way towards wiping out your loss and perhaps give you a little bit of gain. And more importantly than anything, these type of defensive strategies make it easier to trade, because the hardest thing in the world is to, put on a position, it gaps against you. It's, it's the loss is past where you wanted to take, because you're like, you wanted your stop loss to be here, but it gapped beneath your stop loss, so on and so forth. Structuring with options makes it easier to kind of set, as long as you can anticipate it or set yourself up, it makes it easier to then deal and manage with what the market puts at you. And so, as always, we have to trade responsibly. Past performance, whether actual or indicated by historical test strategies, is no guarantee of future performance or success. Just want to emphasize, it's really easy for me to show you this hypothetically and on demand, but I hope that by me showing some nuances, it gives us something to think about when we enter trades. And, hey, if this happens, how will I manage it? Hey, if that happens, how will I manage it? And to give some confidence as far as I have some strategies to add and to adjust. But as always, they're just historical examples. Whatever we post on here is going to be a historical example. So just always having that in mind when we enter a position. There's a possibility that we may sustain a loss equal to or greater than our entire investment, regardless of which asset class you trade. Therefore, you should not invest or risk money that you cannot afford to lose. Options trading is not suitable for all investors. And as always, thank you all for attending. I wanted to keep this part of the presentation shorter, because I'm assuming that most of the people attending have a strong foundation for options, at least in terms of going long or going short. Like, we all understand what that is in terms of long calls, or short calls, so on and so forth. Wanted to share the idea and then open it up for questions in terms of just allowing people to think, what types of trades are we getting into? What types of, maybe how can I add these types of strategies to my trading plan? Just want to hear either from the chat or from those of us on Zoom, if anybody has questions in relation to this, and then we'll take it from there.
I have a question.
Yes.
How often do you use these strategies typically? As you do it every time you take, and in this particular trade, you said you would keep it, you would buy it for 2 or 3 months out. When would you get out of it? And when you were showing us, you had $25 profit, would you continue to stay in to see what it does? Or would you say, you know what, this is making me nervous, I'm going to get out now?
Oh, sure. Okay. So I never enter like a married put. That's going to be off the table for me. What I will do instead, if I'm going to do a long call type position, then I'm going to sell a call against it. And that is, hammered into me by Suzanne. That, every single time. That's in. And the reason why you would do that, the reason why I think that that's better anyway, is you say, okay, I'm going to enter, say, 3 months out, and I want to be in this long call for, at least that's bought me six weeks of theta. Doesn't mean that I'm going to hold it for the whole 3 months, but it's bought me at least, 6 to 8 weeks of theta, depending on how the chart looks. Well, if I'm selling against it, then that's actually holding theta off for me, because I'm selling a call that's out the money. If price rockets up to it and goes through it, well, I don't necessarily get the same gains that I would have, because it turns into sort of a weird type of a debit spread where the call that I sold limits those profits. But it's a good habit to get into, because it lets delta do its thing and it neutralizes the theta of your long position, because you're selling theta on short positions. So if you're in like a 3-month position, then you sell, maybe 2 or 3 weeks out, and you do that a few times to just keep harvesting theta while that position is growing for you. So that's the first thing. I would do that instead of the married put. I wanted to teach the married put because for some traders, it's going to be a suitable thing to do. Like, some traders are going to want to get into a position, or maybe they have, they like to buy stock, they like to hold it, and then they also want to have a little bit of protection on top of it. And that's why that would work. And so now I'll go forward to the protective put. The protective put, this is a better slide for it. I would say that I end up doing this, especially now, I do stuff like this more than I want to. But it's helpful. And usually when I end up putting on either a protective put or a protective call, like, think about them in the same type of ways. Maybe I sold something that moved against me. And so now I've got a short position that I want to cover up. And so if I want to cover that short position up, like say I sold calls and price rockets up like it did today. Well, now I've got to buy a call to kind of help me cover those up. And it's sometimes an easier way to manage a position than just closing the whole thing. And it makes it so that you can kind of give yourself a little bit of space to, especially mental and emotional space, to try to figure out what the next thing to do is. You know, typically when I trade, it's butterflies, or it's credit spreads, and I sell the credit spreads to try to finance the butterflies. And so it's a different type of an idea. But the concept still remains the same. I've got a delta that's moving against me. And so now I've got to try to buy some deltas to put the deltas back into my favor, if that makes sense.
Yeah, that was great. Thank you.
Sure. I'm going to try to jump and look at YouTube to see if we have anything there.
I can see, I have it open. Nothing so far.
You can see? Okay. No questions in the chat yet. Cool.
So I got a quick question then, Jay.
Yes.
Based on what you were just saying, is it that you would use this protective put when you saw signs of trouble in the chart? Or do you go in with the protective put at the same time you're going to do your long call just as your hedge?
Yeah. So to clarify, my preferred hedge is if I'm going long, is to just sell against that. And just try to collect some out of the money premium. So that's the way that I'll enter the initial position. The protective put, those types of ideas will come up when the chart tells me like, ooh, this isn't necessarily going to work so well for me. And so that's when I start looking at the option chain and saying, I hate this pun, but like, what are my options? And because sometimes we have enough capital left in our account where we can sort of adjust our position and think about it in a nuanced way, and things work out for us. Like, and when we would do that is obviously when price isn't necessarily working out the way that we want to, but before price has already made its huge screaming move against us. So if price has already really just obliterated our position and we haven't done anything to manage it, then it's really too late. Does that make sense?
Yeah, absolutely.
Great.
Thanks for that clarification.
Absolutely. Oh, and you know what? Vicky, you asked, I forgot to answer this part of your question, which was, assuming that I'm in this position and there's $25 of profit, when do I get out of that position? And let's sort of go back and forth. I don't have the option chain for what it would be looking like here in the chart. I think if I were trading this live, no, this is what I would do. I'll tell you exactly what I would do. If I were trading this live and my thesis was double top's broken, we should run, I want to hit this target up here. And then I stayed in it while it bounced around and I was like, oh, maybe it's still going to go. I'm not too worried about it. I have time. It's not screaming against me. And then I got nervous and I was like, well, time to invest in some protection, get that protective put on. Once price does this and it comes down here, I'm closing the position. Me personally, as my psychology, I would close the position. And then I would reassess it. But I wouldn't just try to say like, okay, because I was wrong, it's because it didn't go up here. Well, that means that it's definitely going down here. And just try to ride my put all the way down here. I also wouldn't say like, oh, just because it got here, it's done falling, it's definitely going back up. for me, and this is just how I like to operate, I like to say like, hey, my idea actually didn't work. My defense was beautiful. I didn't take a loss on it. In fact, I took a small gain. Close a position, reassess. Probably, usually for me, that means the next day or the day after. It doesn't mean that I'm just like, oh, an hour later, I've figured out what it wants to do and it wants to go higher. That there are traders who do that. I'm just not one of them, because normally the way that I'm going to trade is I'm going to come up with a thesis for what I think the next week is going to do, and I'm going to trade that thesis through the week. And if it turns out that I was wrong, then it means that my plan for the week has to be adjusted, and I have to sit down and think about it. I'm not a day trader. I'm a swing trader. Like, I don't get to just watch it constantly. So for me, I think it's better to have that discipline of reassess it. It doesn't mean that you have to wait a whole nother week, but reassess it, see what's going on, see what you got wrong, and then see if you can make it right on your next entrance. All right. Yeah, then Vicky says, yeah, Vicky, you'd also close at a small profit. Just makes sense, right? Just close it, reassess, and then figure out what's going next. I'll share one more. Oh, go ahead.
Yeah, we have a question in YouTube from MC Grier. I have some long-term positions that are taking a beating. I wanted to see the best way to play defense. Have only been using covered calls.
Okay.
Do you want me to drop that in the chat to retype?
No, I've got it. It's hard for me to just say. I guess I want to give you like a few things okay. Let me pull up SPY again. Everybody knows that's my favorite chart. Without knowing what your positions are, and that's personal. I don't want to get into that, but I want to give you some broad things, and then hopefully you can add on to the question as I go. Actually, let me ask this. Can you just tell me, are they options positions, or are they like you're holding shares?
I'll let you know once he responds or she responds.
Yep. Okay. I'm going to start by answering the options question, and then if you get a response to that, then
yeah, no holding shares.
Oh, holding shares. Oh, I'm glad. Okay. So I would say for holding shares, the nice thing about that holding shares is you don't have theta working against you. And so you have to make a decision as far as what your time outlook is on those shares. If you feel that you have, time to let it recover, then I would let it recover. I think that that's the better way to look at it. I definitely have some shares from some poor decisions I've made earlier in my trading journey that just have to go ahead and do what they're doing. And that's fine. The fact that you can sell calls against them is awesome. I would continue to do that.
Jay, I have a little bit more intel.
Okay, cool.
Trying to decide if I need to up my options level.
Oh, if you're already selling calls against it, I don't think so. I don't think so at all. I would say selling calls against it, and really, to be honest with you, the protective put strategy could be a really nice one for you. In terms of, at some point with this rally that we're seeing, we're going to see some evidence that it's time to go short. I'll be honest with everybody. I thought it was here. And so I definitely had some butterflies just go splat against me today. But it happens. But I would say if you're already selling calls, that's great. Adding in the repertoire of protective puts, when you start coming up with an idea that, you know what, this leg up is probably running out of time, let me start shorting against these positions and making money as they go back down. So I would say that's the first thing to add to it. And then the other thing to keep in mind is, if I said this at the beginning, but if they're shares, just try to get like a little bit of perspective. Like, this is just the weekly of SPY. Like, chances are, if you bought shares of anything this year, they're down just like everyone else who bought shares at some point this year. So I think that what I'd like to give you encouragement around is just the idea that, the market's going to stabilize. It's designed to keep going higher. Obviously, that's not what we got this year. I'm not yet convinced that we've put a bottom in. We might have, but I'm not convinced of that yet. And that's okay. If you're selling calls against it, add those protective puts. And as you learn more, you'll learn more strategies. But I think that selling calls and then also buying puts against it when you think it's going to go down can be a really nice strategy to generate income while you're waiting for those shares to grow. And then you're just banking profits when the shares do finally grow. Well, now, like, your account is in a really awesome place. But if it's shares, I just got to emphasize, I would not be too discouraged.
The response was, thanks, I'll wait it out in that account.
Cool. Absolutely. The other thing I would add, of course, is, and I'm not sure if you are a subscriber to the rooms or not. What I'm sharing on YouTube now is the very basic building blocks of ideas that build and get bigger and bigger. And so I can't teach them all in one lesson, but I will say that Suzanne is a wizard about coming up with strategies on top of strategies. And it's really nice to just have that library to have access to.
Jay, there's one more question.
Yep.
Is that a protective put to use on shares is the question.
Yeah, absolutely. Now, yes, is the short of that. You can absolutely use it on shares, because the idea being is that you're long on a position, it's moving against you, and that position can now start to harvest some profits for you as you buy puts. And so, your broker isn't necessarily going to look at it as you're buying a protective put. Like, they're not. The protective put is basically just a name that we call it to give it a classification. But the idea is, hey, I'm holding these shares. I think in the long term, they're going to go higher. Probably not right now. So as the market goes down, I'm going to buy some puts and profit as it goes down. And the nice thing about doing that in shares that you're already holding is those are companies that you're paying attention to. So it's not like it's a foreign company to you and something that you're not familiar with. It's a, probably a chart that you've been watching and that you are actually familiar with. And you say like, ooh, when it gets back up here, and on one hand, I'm going to feel good because my P&L on the position is going to start looking a little bit better. But on the other hand, I'll be a little suspicious of it. So maybe go ahead and buy a put at that place to get myself some protection on the next leg down. But I'm glad you asked that. There's absolutely you can do that to hedge a share position. All right, I want to share one quick thing from that. Oh, I'm sorry, Vicky. If there's another question, I'll answer it. But I just had like one little bonus thing.
Nope, I'm just gonna say all quiet, except you gotta thank you.
Oh, okay, cool. Yeah, so I'll just share one more thing from the XLE chart. In my mind, I feel like I kind of purposely shared, obviously with the benefit of hindsight, it's easy to share a poor setup, but I wanted to try to just share, in my opinion, something that looks like a better setup. All right, so this is that same chart, and just a couple things that I have notated on it. XLE is on a very long uptrend, and so you can see, and I kind of wish that I had a longer view, but I don't on this. Actually, you know what? No, I won't. XLE is on a rather large uptrend. I have this little gap highlighted. But you can see that it's originating over here. Obviously, this is the area that we wanted to protect ourselves in. This was the day that we were looking at getting out of that second position and thinking like, what should I do next? And so notice at the end of this day, if we were watching this, we would have noticed that, well, we have a gap fill and then something interesting happens. The next day we get an inside bar. And what I mean by that is the range of this second candle is completely inside of the first candle. We combine that with, okay, we've got trend line support down here. We do have a reason to think of structural support here because we closed the gap. We can start thinking, because of this inside consolidation, that we might be expecting a move higher. And so just an idea would be the next day thinking about going long if we take out the inside bars high. And so just wanted to kind of share that little idea. So there's context with the trend line, there's context with the gap, and then there's detail with this inside bar. So it's a number of things that's going with you, as well as the fact that we know that while the market was getting beat up, energy was really, really strong. And so for me, this is the type of a trade that I like to take more than this type of trade. I think a few weeks ago, we talked about, I'm not a great breakout trader, and I'm not good at it. If I were getting in up here, psychologically, notice it takes out this high and then runs. Psychologically, that's just a harder thing for me to do. I am a little bit better at thinking of moves that kind of rebound. And so the idea is the terminology that I used before was I'm fading this move. So this move came down. I have reason to believe, because of a number of different contextual elements, price is going to go higher. Does that mean that I get it right every single time? No, I got it wrong yesterday. But I just wanted to share that because I wanted to emphasize I don't really love this as a setup, which is why it works for a trade gone wrong. I like this as a setup better. And that's just, it really does. It doesn't mean that I'm right, that taking out a high and running, it doesn't mean that that's a bad setup. It just means that this is the way that I like to trade. So I just feel more comfortable sharing a little bit more about the way that I look at it. All right, if there are not more questions, I do want to go ahead and wrap it up. I want to be honest, I tried today with today's presentation to keep the information that I was sharing a little bit shorter than I have in the past. And the reason is I'm noticing we're getting a lot of replays on YouTube. And I do think that when we get the opportunity to watch, pause, take notes, I think that if I'm a little bit more concise and if I'm a little bit more brief, it actually makes the points a little bit easier to digest. So that's my purpose for that, for going a little bit sharper. But by all means, if today felt rushed, I am super open to feedback. You guys can tell me right now in the chat, like, no, you went too fast, so on and so forth. You can also always reach out to me. I'm super happy to answer questions in Telegram. I love answering questions. So please do that. But just wanted to kind of let you know why I was thinking about it in those terms. And if there aren't any other questions, I just want to say good night and look forward to talking to everybody next week. Oh, thanks, Vicky. Oh, good to see you, Lynn.
Thanks, Jay. It's great.
Thank you. All right. Good night, everybody.
All right. Thanks, Jay.
Yep.